this right. So we're now recording. So if we're good to go, let's get started. Welcome to Africa Ascending, a podcast series looking at key issues affecting the African business environment, and more particularly its impact on the insurance sector in Africa. Hosted by Afro-Asian Insurance Services and Africa Ahead, in this series we will be looking at everything from water regulations, currency devaluation and climate change. To access this podcast in other ways, we'll be appearing on Africa Ahead, www.afapublishing.com, Spotify, and on the media page of afroasian-insurance.com. My name is Liz Booth, and I'm the editorial director at Africa Ahead. With me, I have
Uday Patel, CEO of Afro-Asian Insurance Services Limited.
Today's conversation considers how the insurance sector in Africa can play a greater role in infrastructure development on the continent. Africa has a vast infrastructure deficit. The African Development Bank estimates that Africa needs US dollars 495.6 billion annually until 2030 to meet its SDGs, or 86.7 billion US dollars annually to accelerate its Agenda 2063 structural transformation process. Those numbers are absolutely huge. The financing gap for both those targets amounts to a staggering 81% of the total need. To discuss this, we have Amalia Loe, a partner at Clyde & Co Tanzania, who recently wrote a report on the need for more infrastructure development in Africa. Kaz Hansa, a long-time player in Africa's insurance sector, formerly of Munich Re and Continental Re, and now with Firedart Engineering, and Simone Lauper, a partner at Faber Consulting and a co-author of a recent report for the African Insurance Organization on the role of insurers in Africa's infrastructure development. Welcome, everybody, and let's get on with the conversation. Amalia, I'm wondering if you can talk us through the scale of the problem you see it and how the private sector can add to donor funds and foreign direct investment.
Thank you, Liz. I do agree with the fact that Africa does have a need for quite a lot of infrastructure development to just sort of fuel the entire process of developing the continent and meeting the needs, the commercial needs in the African economy. I think I can highlight, in terms of the scale of the problem that I'm seeing, I can highlight three factors. First is the regulatory frameworks. For example, I'll speak from a Tanzanian law perspective, where you've got insurance mainly being quite closed, meaning that insurance companies which are not registered here cannot operate within the country, but also projects being undertaken within the country must procure insurance services from domestic insurance companies. With that can protect the domestic insurance market, infrastructure projects do demand quite a larger sort of insurance services, and it would be important to sort of exclude or expand and allow foreign sort of international insurance companies to work with local insurance companies in order to finance sort of infrastructure projects. Also, the issue of long-term capital. Most insurance companies, primarily based in Africa, have issues or do not have long-term capital, and taking into account the currency instability and depreciation against the dollar in the long term creates quite a challenge, especially in the case of infrastructure projects, which are capital intensive and for quite a long period of time. The other last issue that I have seen is insurance prefers low risk projects, that is bankable projects, which have sort of been de-risked to some extent, but most infrastructure projects within Africa have real and at times perceived risks. So it's important for such projects to become more bankable in a way that can attract more insurance companies and support. In terms of how the donor funds and foreign direct investment can participate more, especially in infrastructure projects, I would say encouragement and promotion of public-private partnership. Also, more equity funds or sovereign wealth funds putting more money into infrastructure development, but also African governments being more open to such investments and sort of lessening the rigidness in terms of regulatory support and the bureaucracy which is usually involved in such projects. I have been involved in a number of these in negotiations, but at the end of the day, very few of them end up materializing, and it's sometimes conflict of interest between the government and the private investor. And it's important to sort of understand that they bring in the money. Infrastructure projects over a long period of time, so there has to be sort of a meeting point so that these projects can kick off. Thank you, Liz.
Thank you, Amalia. I'd like to come in there. I totally agree with you. And I think the way forward to deal with the difficulty you just described, potential conflict, is certainly in how the contracts are formulated or the contract philosophy. So if we're talking public-private partnerships, and especially if you're then creating systems or philosophy, I should say, build, operate, transfer, build, operate, own, or even build, own, operate, and then transfer, where government comes in as a very much interested party. A consortium is created so that the parties are tied to the hip, as it were, and you then have a commitment, long-term commitment. Government does what is best at, securing political stability, making sure statutory issues are dealt with, and especially when we're talking infrastructure, securing the rights of use of land. The private sector then has fair assurance on the returns, which brings in, talking insurance, bankable assurance that there's bankability. So I think public, for us going forward on the continent, it has to be a commitment, public-private partnership. This will also talk to national strategic intent, where there's a common focus on the way forward, coming from business, coming from government, and other national interests like civic society and labor and so forth.
And maybe I can just add on that point that Cass made very clearly. It not only aligns the interests between the public and private, but also what these partnerships bring along is technology, expertise, and efficiency to these kinds of projects.
Can I just ask a very simple question? I'm sorry, I'm coming at this topic as a novice, but insurance companies have the freedom to invest their surplus funds in government treasury bills. Is there some mechanism by which the investment in government treasury bills with the cooperation of the government can be assigned to be allocated to infrastructure projects or long-term government projects? Is that a possibility? Because obviously, one thing is certain, that if the government gets its hands on money, it can spend it any way it wants. But is there some mechanism that can channel it?
Amalia?
Yeah. So thank you, Uday. I think from my perspective, I think, yes, there's a possibility of channeling that. And then that's why maybe we can call it a sovereign wealth fund, where insurance companies are buying into bonds, but then it could be specifically allocated to a certain fund that is co-managed between the government and the insurance companies in order to focus solely for using that money in infrastructure projects, because most bonds and bills that are issued in most African countries are purchased by social security funds and insurance companies. So if there could be a side agreement that, yes, we are buying the bond, but this is how the money will be utilized, and for the benefit of both sides, I think that will be more attractive, because as well as there will be sort of a shared risk, because if the insurance company is just putting money and buying the TBs and T-bonds, and the government uses the money for infrastructure projects, is carrying the entire liability or responsibility and the risk by itself. But if the insurance companies come in as co-investors, sort of distribute the risk, and the insurance companies are known to be quite experienced in terms of risk management and sort of planning. So I think it will bring more benefit in that way, but it can be done mainly through funds, which are sort of managed by both the government and the insurance companies. Thank you.
And I would like to add here, we found, for instance, a very interesting example and potentially a good model to learn from for the African countries. So, for instance, in November 2024, the Philippine Insurance Commission issued a new guideline encouraging the insurance sector in the Philippines to invest into priority infrastructure projects. Thus aligning the regulation with national development goals and promoting stronger public-private partnership. So that is a very interesting model that definitely worth to have a look at how it pans out over the time.
Amalia, was that siren at your end when we were when Simone was speaking just then? If that
Yeah,
happens,
I think.
Can you just quickly mute your microphone if it's some noise comes in? Simone, would you mind just repeating that point? Sorry to put you on
Sorry,
the spot.
Simone. Sorry.
No problem. No problem, Liz. I can repeat it. Okay, let me give. So there we found, as part of the research we have done for our report on behalf of the African Insurance Organization, we found a very interesting example from the Philippines. And basically, in November 2024, the Philippine Insurance Commission issued a new guideline encouraging the insurance sector to invest into infrastructure projects, thus aligning the regulation with national development goals of such infrastructure projects and promoting a stronger public-private partnership.
Thank you. So that leads us to the question of the state of the African insurance market, doesn't it? Because it's all very well encouraging them, setting up these mechanisms, but is the insurance market able to get involved? Has it got the capacity? Kaz, do you want to talk about the state of the construction insurance sector across Africa as you see it?
Yeah, sure. And it's a good question. And of course, it comes down to the magnitude of these projects, the capacity, that is, in other words, the what we would call the value at risk, or the total sum insured in our language as insurers, and whether that financial capacity is there, prevails not only nationally within country, and given reinsurance support of the various insurance companies in that country, but then also regionally, and then too on the continent. And I've always argued that we must nurture and develop local insurance sectors, the economies on the continent, and the engineering side is a specialist field. And you'll find that insurance companies, by far and large, on the continent are very good at what I would refer to, without detracting from the importance of those insurance programs, classes of business, personal lines and motor, for example. They mainly focused in that area, and the bulk of their business revenue streams comes from that. And it's the specialized fields, in particular, let's say marine or performance bonds, guarantees, and other new forms of insurance, PVT, political violence and terrorism. But importantly, the field that I prefer to be in, and it's largely been my career that I've made, engineering insurance. And so, Liz, that takes me to the second part, is the capacity, financial capacity, but maybe there. But I think to a large extent, I don't think we have reached critical mass in the informed capacity in how we deal with that risk transfer of these specialized fields, project fields. And so there maybe we need lots of development. No different, I would argue, that if in Africa we're arguing about moving ourselves out of the extractive, the primary industry, into secondary and tertiary to develop and also diversify our economies. To my mind, I argue quite firmly, we are not going to get there until the day arises when we develop our capabilities in the STEM fields, and in particular engineering. You have to have far more engineers on the continent, based in the continent, being developed within the continent in order to move from primary industry into beneficiation, industrialization. And with that will help, of course, the insurance sector to be more engaging in the risk management side and then in the risk transfer side, that is the underwriting, and in particular, of course, then claims handling, so that we engage in a meaningful way and that we are there to provide the necessary sleep easy when those accidental events arise.
Kaz, I think you were with us when we had a conversation about this in Zimbabwe last year, and we talked a lot about construction insurance and infrastructure. And one of the things that came out of it was the fact that there's so much political risk tied up with this, that if you're involved with a big government project, all those political risks come to the fore. So it's not just about the construction itself, but all the ancillary things. And the other thing that I remember coming out of that conversation was the fact that African insurers don't know about these projects often at an earlier enough stage. And so they don't even get a chance to bid on them, perhaps when they could actually provide the cover. Simone, is that something that you found in your report? Did either of those two issues come up?
Definitely. We spoke to a series of experts on the African markets, and we managed to collect a few of the recommendations that, for instance, the insurance side gave for regulators and governments what they could do to help promote these type of projects. One, the very basic, but definitely not simple to achieve, is to stabilize the macroeconomic conditions in the countries, to encourage. Then another one is to expand the financing, because we have definitely seen also across different presentations that the debt levels of the governments are so high that it's limited how they can contribute to these kind of projects financially. So they need to open up and create good conditions for other investors to step in. But we have clearly heard also the insurance saying exactly what you said, that engaging the insurance early in the planning and feasibility study is also very important, because the role of the insurance is threefold: as a strategic risk advisor, as a risk manager, and potentially also as an investor. So in their role as a strategic risk advisor, they have a very good understanding on how to reduce the risk profile of such projects, because they know simply where to build, how to build, to reduce the risk of such projects, and making, what Amalia said at the beginning, these projects more bankable and appealing for investors. So there's a whole list of recommendations that the insurance sector has given, promoting PPP, as Kaz has mentioned, and aligning the interest together with blended finance, but also supporting the local capital markets to first keep the local capital in the country, and then attracting more additional capital from outside. So these are some of the insights we have seen.
Can I just pick on one specific point you made, Simone, which is quite pertinent, and that is the size of debt that African governments face. Isn't that a cyclical problem, in that you need capital investment in a country to generate wealth through the multiplier effect? But then these governments, because of their debt, cannot raise the funds to make that investment. So it's a circular argument over there. And finally, they need to have a government-to-government investment agreement where the investing government, I'm not going to name any countries here, but we all know who historically these are, then call the shots on everything from the nationality of the contractor, the materials that are going to be used, obviously favoring their country, and where the insurance is going to be placed. And it is all taken out without benefiting the domestic government. So, I mean, I think until that debt situation is resolved, which is a huge problem, do you feel this will be a perennial problem?
Well, I think definitely the governments have to do the homework. In that they need to strengthen the domestic resources, because what we have seen that the levels, for instance, domestic revenue remains very low across Africa. The median tax to GDP ratio is of just 13.3% compared to other developing regions where you have a 15.4% or high income countries with 21.1%. So there's no way around that. You have to clean out your house, increase these domestic revenues, also restructuring the debt levels, because at the moment what they are paying in terms of just to service the existing debt levels is huge, over $100 billion US. So this is definitely a first priority. But then, as I mentioned before, mobilizing, then it becomes easier to mobilize other resources if the governments have done this first step. And then, of course, anything that helps mitigating risk of such critical infrastructure projects is extremely important. I mentioned the macroeconomic stabilities, government regulation stabilities. That's where governments can really act upon. And then, of course, not to forget that the insurance sector can contribute in a very meaningful way, from risk advisor, risk manager, and risk investor as an institutional investor. So the problem is so big that everybody needs to step in and step up and help reduce this gap, this immense infrastructure gap in Africa.
Yes, indeed. I mean, Uday, what you're raising points to a solution of PPP. It's exactly as Simone is herself just describing. So it implies that it's exactly there that we should be going. And I think other countries, developing countries, have found this as being a very meaningful way of moving things forward. If governments don't have the money, then we need the private finance. But the private finance will come with its own particular requirements to try and ensure that the project is successful. But the local governments, on the other hand, would like to ensure that there's also local input and development, local expertise that is left behind at the end of the day. And so I think it comes with a sense of fairness and goodwill, a good deal for all parties, win-win, as we say. And how better than to make a very firm public-private partnership arrangement to ensure the bankability as well, because it is about, at the end of the day, political stability. We find that projects can sometimes fail because there are different interested parties within the country. There are potentials for NGOs, for good order, to not see a project as being feasible from a world perspective. Social media influences. And so there has to be those kinds of assurances that this project is bankable and will see completion in a timely way and in a successful way financially as well.
Maria, so certainly I would let you come in here, but I just wouldn't mind just sort of finishing us off with your thoughts on it and sort of a positive way forward that the industry can take itself.
I think just to add on what...
Oh, we're struggling to hear you there. You're going to have to come.
Oh, sorry, I forgot that I didn't unmute. So let me start. I'm just adding on to what Cass and Simone said, especially on the question that Uday has asked. I think because governments have a lot of other responsibilities, from infrastructure to health and security and everything else. There's a need to sort of emphasize on public-private partnership. But whenever public-private partnership comes into play, there are always conflicting interests, because the private party that is coming in, which could be another government within or outside of Africa, but in most instances it's outside of from outside of Africa, they're investing because they also have an interest in the project. That is, they want to use their contractors, they want to use their experts, they want to bring in their insurance companies to participate in the project, so that they bring benefit to their country and also answer to the nationals of their country. But as the receiving country in Africa, we also want to build that expertise and sort of bring more benefit. And I think at that point, it shouldn't be impossible for both parties to come and figure out how to make sure that each party benefits. And also African countries taking into account that this infrastructure project, whether it's a road, whether it's a port, it's something that should be in existence for the next 100 years. What is it that we can forgo for now, and allow these companies that are building here to benefit a little bit slightly higher than what we would be gaining? But in the long term, we know that after this PPP project has matured, then we still remain with an asset that can continue to be used. But then you've also got localization requirements and regulatory requirements within the country. It shouldn't be just a foreign entity coming in and providing an insurance policy, or a construction company coming into the country directly 100% foreign. There has to be some sort of a JV that has to be emphasized to make sure that there is sort of a benefit that is brought in locally. And in my experience, as much as these localization requirements can sort of act as a barrier, but if well navigated, it can bring a benefit to both parties. It might not be exactly 50-50, but at the end of the day, we are receiving the investment, so we can't be at 50-50, but there can be a balance of sort that manages to bring the economic value that the private partner is coming into the country to invest.
Thank you very much indeed. I think sadly we were going to have to draw this conversation to a close because we've been talking for a little while now. Uday, can I hand over to you to say goodbye to us all?
Thank you, Liz. And thank you, Amalia, Simone, and Kaz, for such a riveting discussion. I think only time will tell in the future how this is all going to be to pan out. But I also want to thank our wider audience. And remember, here at Africa Ascending, we ask the awkward questions in the hope of finding solutions. Thank you all for joining.